What is up, guys? Raymond here with another financial statement analysis video, and this is episode 8 in the German materials sector stock analysis video series. And in this video, we're going to be presenting you a financial statement analysis of Kloeckner. If you're new to my financial statement analysis videos, what we do in these videos is to analyze the top 3 financial statements of a company, or relevant to a company, those being the income statement, balance sheet, and the cash flow statement. And we look for the key factors of each statement to point out key strengths as well as key weaknesses of a particular company and how they can improve, as well as the financial strength and viability of a company's future. So without further ado, we're going to get into the key ratios, which is external from the financial statements, and we're going to get into those just before we start analyzing the financial statements, just to see where the company is at. With regards to market capitalization, the overall price of a company, of a stock is, Kloeckner has a market cap of 887.28 billion euros, slightly under 1 billion euros. Whenever we look for a stock to invest in, potential stock to invest in, I always suggest that the stock price slash market cap should be 1 billion of the denominated currency or more, simply because it shows that it shows a minimum threshold of attractiveness to shareholders. PE ratio, the price to earnings ratio, is the overall price of a company divided by the earnings per share. So the earnings for a particular year divided by the amount of shares outstanding. And we get the earnings per share, which in this case is 6.24 euros. And then we get the price of the stock, the overall stock, which is the market cap, divided by the earnings per share. Sorry, the price of the stock, which is in this case 8.751, and then we divide it by the earnings per share of 6.24, and then we get the P/E ratio of 1.43. So we always look for a stock that has a P/E ratio of 10 or more, 10 or lower. 10 is actually extremely low. It shows that the company is very, very cheap at that particular period. But usually, I don't know if it's more often than not, but usually when the company's P/E ratio is 10 or less, it shows, of course, a low level of attractiveness to shareholders. That could be just reflecting almost purely the economic situation that people are in. People that might not have too much free cash to invest in stocks, or they may have been a previous shareholder and had sold a large stake or all of their stake to be able to get liquid funds to meet short-term needs. But it is definitely it does definitely signify a buying opportunity, considering that the other requirements are met. With regards to revenue, the total sales of the company for this particular financial year, 2021, the revenue figure was 7.44 billion euros. So that is almost an 800% disparity with regards to the overall price of the company, as well as compared to the overall sales, which is incredibly strange. I believe what had happened was because this financial year is such a tough one for companies, especially for smaller companies. Smaller companies usually suffer more so than larger companies, just particularly due to infrastructure. And I believe what had happened was the total revenue was the average total revenue over the past 3 financial years was probably around 7.44 billion euros, maybe considering a little bit of earnings growth, a little bit of revenue growth. And what had happened was the market cap this particular year had dropped quite significantly, and I believe that is probably the reason why there's such a large disparity. Let's just check to see if we are correct. So the market cap had dropped 26% just in the last financial year alone. I don't believe that explains away an 800% disparity. It definitely doesn't, actually. It probably explains a quarter of it, but I don't believe it explains 800% disparity. Anyway, the dividend yield is 11.224, which is more than double, more than 100% more than what we expect as the minimum, regarding if someone was to invest in a stock purely for dividends. The PE ratio, as we just went through, is 1.43. The beta is the overall risk level as represented in a number, which is 1.9, which is 90%, almost double the market average of 1. which shows that the overall volatility of this stock is almost twice as high as the average volatility of a stock in the stock market. That definitely doesn't represent that definitely doesn't represent the company in a good light. But then again, the dividend yield is extremely high, but we also need to watch out for high dividend yields. High dividend yields are usually a consequence of the stock price decreasing very rapidly and substantially. Even still, the stock price didn't dip too high or high enough to explain such a high dividend yield. But then again, we need to check if the company has actually declared this dividend to be paid out in the next dividend payout period. So anyway, we're going to get into the income statements of the three financial statements. The income statement shows that the company has made negative profit in the 2019 financial year and the 2020 financial years, which is not good at all. The revenue figure decreased substantially from 2019 to 2020. I believe that as well as the net income, respectively, the net income decreased slightly less than the relative to the revenue decrease. The revenue decrease was quite substantial, but either way, both periods were quite bad for the company. The 2021 financial year shows that the company increased its revenue quite substantially, by a few hundred million euros, and the company also increased its net profit figure to quite a substantial amount. Also, I believe that's around 10 or 12%. So that's definitely positive for the company. I would say that a company needs to show a consistent, at least 3-year continuous period of positive and substantial net revenue and profit margin figures for it to be at least considered as a viable stock to invest in. I don't believe inconsistency, especially in this case, especially considering negative earnings, is a good indicator of a stock's strength. So anyway, let's get into the balance sheet, the second of our financial statements. The balance sheet shows that in 2019, the company had a debt to asset ratio which is quite bad. I believe its liabilities were over 50% of its assets, and it's the same thing in the 2020 financial year. The connection between 2019 and 2020 shows also a link to the income statement, which shows that the company decreased its income, its total revenue, as well as its net profit in the 2019 and 2020 financial years, and also it decreased its assets as well as its liabilities, respectively. The difference being that the company decreasing its the company's decrease in assets as well as liabilities is more positive on a company's performance as well as its health, compared to an income. Compared to a company decreasing its revenue and its net income. Lastly, the 2021 financial year, as we saw, similar to the income statement, the company increased its overall assets quite substantially, as well as its overall liabilities, which is good for the company, I guess. Lastly, we're going to check the cash flow statement, which shows how a company manages its cash flow, as well as how it manages its liabilities. The starting line for the cash flow statement is the net income for the last financial year. So that was 629 million euros, and the company lost 305 million euros from operating activity. Let's see where it lost most of that money. Changes in working capital was constituted 1.16 billion euros of loss. But it did gain a few euros in other areas. The cash flow from investing activities constituted a loss of 59 million euros, which is not too substantial considering the company's market cap as well as its revenue. 84 million euros was spent on capital expenditures, and other cash flow items gained the company 25 million euros. Cash flow from financing activities, which is the last aspect of the cash flow statement, constituted 248 million euros gain, which was constituted which was a result of the company increasing its debt amount by 261 million euros. And the net change in cash overall for the 21 financial year was 114 million euros, which is I believe it's lower than the so it's lower than the prior financial year by quite a substantial amount. And let's check the 2019 financial year. So as you can see, the net change in cash has decreased quite substantially over the last 3 financial years. Of course, it's spending a lot of cash expanding the company's assets. That's probably a trend in the company's operations, and probably explains why the revenue figures are so high, because the company can probably is probably very productive, but doesn't necessarily know how to capitalize on the on the profit, capitalize on the revenue and generate a lot of profit as a relative to revenue. That's probably something that the company needs to focus more on. But without further ado, I'm going to close this video. Thank you guys for watching. I will see you in the next one.